Good morning, magandang umaga po. Today we're going to talk about something that I did when I was in my early 20s. And I had to make a decision, especially when I had my daughter, my first child, and that has something to do with insurance. Now, this may not be of interest to the people who are now in retirement and therefore they don't need insurance. But this may be of interest more to the younger generation, preparing for your old age. And one of the things, just like you think about car insurance for your car or medical insurance, more as you are aging on medical insurance. And this has something to do with life insurance. Very, very important. So, stay with me, we'll talk about it. Let's move on to the topic of life insurance. There are two basic, popular type of insurance policies. One is whole life insurance, and the other one is the term insurance. We are going to talk about the distinction between the two. The first one, whole life, in a nutshell, I'll say to you this way. You buy insurance today, you have a certain premium to pay, and that premium doesn't change for the rest of your life. Okay? Whereas a term insurance is just like your car insurance. You can terminate it anytime. It does not accumulate cash value. The whole life insurance, as time goes on, if you decide you want to terminate it, you can get some cash out of it. And when you retire, you get a huge lump sum payment. So you are not wasting every money that you are paying in. Whereas term insurance is just like buying a car. You buy the insurance. After 1 year, you pay another insurance for the year, another insurance. You sell the car, you get nothing. Everything is spent. Whole life, it accumulates value. And that is the attractiveness of whole life policy. And that's why a lot of sales agents are selling that concept. But let me show you the secret of how you should analyze this. And when I was age 22, 23, very young, I talked to an insurance agent, whole life insurance agent, and he tried to convince me for 2 months. And after I analyzed the whole situation, I said, no, I decided not to get whole life, I decided to get term, and I'll explain to you why. And he kept on convincing me, but I said, no, you cannot convince me. I showed him the work papers. At the time, there were no Excel yet, okay? So I was doing everything in pencil and paper. And I said, show me what I'm doing wrong. And if you can prove to me that I'm doing something wrong, I will buy your policy, okay? He never got convinced. I guess he does not understand the whole thing. Now, let me see if you can understand this. So let's try to show you something, okay? Now, of course, when I was 20 years old, the premiums were different. Now, I looked at the current one and I say, well, what are my choices? And let's say, now, these numbers do vary a lot, but I'm assuming today you're a male and age 30. Like what I said, this is really more for the younger generation. When you're already 60, nah, forget about this. But when you're age 30, 40, 50, it's still relevant. And let's say you have a choice of, I'll get myself 250,000 insurance, 500,000 insurance, and 1 million. A whole life, okay, this whole life, and this is a 30-year term life, okay? On whole life, your annual premium at $250,000 coverage, that is when you die, you collect 250,000, is 2,145 per year. If it's 500,000, it's 4,235. If it's 1 million, 8,380. I believe at that time I just bought a 500,000 policy because at the time that's big money. If I die, that's going to be enough for my wife and child to survive. So that's not a problem. Later, I bought a policy worth 1 million because at the time I'm worth a little bit more, okay, and cost goes up, so they will need a little bit more to survive. And I kept it at 1 million until later when I brought it down to 500,000 and then down to 100,000. And this year, zero. Okay, let me explain. Now, so for a whole life policy, this is the premium you're going to pay. Oops. Now, 30-year life term, you compare that, and this is the premium you pay. All right. However, the insurance agent does not disclose that to me. I have to do it on my own. I said, let me compare this against term. So I have to get somebody to give me a quotation for the term insurance policy. What the insurance agent will usually show is the following. A 500,000 age 30 whole life premium will be this. 4,235 all the way up to age 30. And I'm showing 1 to 5, then every 5 years after that. Okay? And this is another chart they will show you. Oh, look at the cash surrender value of whole life policy. Okay? If you change your mind at the end of 5 years, you can cash out and receive $20,000. Interesting. If this were term, you get nothing. Okay, you get nothing. Now, if usually they do not pay you pay you anything if you change your mind after 1 or 2 or 3 years. Okay, well, some of them will pay you something for 3 years, 4 years, 5 years. Some will be 5, 10, etc., etc. And then they show you that if you change your mind in 10 years, you'll get 41,000. 15 years, 63,000. If you went all the way up to 30 years and you want to cash out because at that point you're already 60 years old and you don't need an insurance anymore, you can cash out and receive $136,000. All right? That's what they will show you. Nothing more. Now, but this is how you will compare this. And where first year is very low, this is an example, let's say $120, and then every year it goes up. The policy I had until I terminate the insurance is something similar to this. I was paying a little bit in the beginning, and then towards the end, this year, for example, I would have paid $1,700, all going to nothing if I don't die, and that is just for the security of having 100,000 in coverage if I die today. But if I don't die today, that 1,700 is gone. Is gone. But during the beginning, it was really cheap. Okay. Now, so look at the difference here between the two. Okay, a lot of money, a lot of money. And the reason that is they're able to invest for you, okay, this difference, and they will guarantee that they will pay you so much. It's a guaranteed cash surrender value. Okay, so let me show you how this thing works. During the first year, you pay them $3,867 for the investment part, meaning the the premium you paid for the insurance part. They're insuring you $500,000 in case you die, but you're young. What's the chance that you're gonna die? Probably very, very unlikely. It's possible, but very unlikely. So the difference, they invest, and let's say that this is the cumulative difference now. This plus 6% that money they make is this one. Okay, and then next one you pay again extra $3,867. So you add that to this number, okay, and then add 6% to that total, and this is now your balance. The third year, you do the same thing. This extra money that you're paying in, you add to the cumulative balance that they have in the pot, and then add 6% to it, and this is the balance. Now, if they make 10%, gee, this is going to be humongous. Okay, so at the end of 5 years, they would have made 23,000 and all the way up to 324,000. Now compare that to the so-called cash surrender value that they will guarantee pay you. Okay, And usually this is anywhere from 0.5%, maybe 1% is very high. Usually it's 0.5%. Okay, look, 20,000, 41,000. They tell you that this is your guaranteed value. So look, at the age of 60, okay, they will guarantee you 136,000 payout. So you'll get back 136,000. So it looks attractive, right? Okay, but if you kept that money and put it in a 6% yielding investment, you will get 324,000. Big difference. So how much more? You will get 188,000 more than the money that they're guaranteeing you. All right. So just try to follow this through. First year is 3,867 plus 6%. This much, 4,099. Next year again, you pay 3,867. They added the 4,099, and then add 6% to that, 8,444. And you keep on doing that until 30 years hence, and you will have accumulated 324,000. What do they guarantee you? 136,000. Now, this is just an assumption on my part. It depends on what they want to guarantee as a yield. Some of you, some insurance companies will say, let's give 0.5%, 1%, but they're not going to give you too much. Why? They're taking the risk. They're guaranteeing you that. Here, there is a risk that maybe it will even be a loss. Okay, if they invested that in stocks, this is years ago before President Trump, prices came down. So you would lose money. So there is some risk involved here. Okay, so that is the difference. And when I showed that to the agent, he couldn't give me an answer. Let's go on with the next chart. Choose the term insurance. Okay, how do you make a decision? Choose the term insurance if you only need life insurance to replace your income over a certain period of time, such as years or raising children, years you're raising children or paying off your mortgage. So that is some of the purposes of term insurance. If you want the most affordable coverage, you want insurance, but you can afford to pay that much. And I was in that boat when I first started in this country. I said, oh, gee, I cannot pay $3,000, $4,000 in insurance, but I can afford $380. So to me, number one is, can you afford it? Because if you cannot afford it, you only have one choice: you get term. Think you might want permanent life insurance but can't afford it? Most of the term policies are convertible to permanent coverage. The deadline for conversion varies by policy. That's another thing. If you look at term, make sure it is convertible, so you have the option to convert it to whole life insurance at some point in time, in case your situation changes. If you think you can invest your money better, buying a cheaper term policy lets you invest what you would have paid for a whole life policy. That's the one I illustrated to you. Now, when do you choose whole life insurance? If you want to provide money for your heirs to pay for inheritance or estate taxes, okay? In 2020, though, keep this in mind. Sometimes they tell you that, okay? Oh, you know, with this life insurance, your heirs, your children, your wife will not have to pay any estate inheritance tax. But in 2020, as of today, you don't pay any of that anyway, unless your estate is over 11 million for a single individual or 23 million per couple. So who cares? So in this case, let's think about single individual. Let's say I got a coverage for 1 million. I would have not paid any taxes anyway. Okay. You have a lifelong dependent, such as child with special needs. This is very real. If you have a special needs child requiring care after you're gone, it's very important to have this. Okay, but you can do the same thing with term. Okay, now you want to spend your retirement savings and still leave inheritance or money for final expenses such as funeral costs. Obviously, plan to leave a business or property to one child. Whole life insurance could compensate your other children. All right. So what that means is, let's say you have a $1 million business, you die, and you have 2 children. Okay, you'll have to sell that so that you can divide it, 500,000 for each. But if you have a $1 million coverage, one child can get the business, another child can get the cash proceeds from the life insurance. All right. So to summarize, term and whole life. Choice of policy, term, you have. Okay. You have to remember though that just like I'm talking about the length of time, you can only get for 1 year, for 5 years, for 10 years, because you may change your situation or cancelable anytime, you can say that. But in the case of whole life, that's intended to be from the beginning all the way up to retirement. You have it. If you change your mind, like in the first 5 years or first 3 years, depending on the policy, you could lose a lot of money, okay. Provides lifelong coverage that is intended for whole life. Premium generally stays the same for both term and whole life. And also for the when I say premium generally stays the same for term, is there are policies where you can pay in the beginning low and then it goes up, so it does not stay the same. But you can also get one where it's an even premium amount every year. Low premium, definitely term. Life payout, low premium life insurance payout amount is guaranteed. Okay, that's the so-called cash surrender value. Life insurance payout is guaranteed. That is on. Let me see. Life insurance amount. Oh yeah, this is not the cash surrender value. This is if you've got a 100,000 coverage, that's guaranteed. That's what you will get. 1 million coverage, that's guaranteed. That's what you will get. In both cases, you will have that. Accumulated cash surrender value. Term does not have any cash surrender value. Here you get cash surrender value again because you paid a little bit of excessive and they're investing that excessive amount so that they could give you cash surrender value. Might be eligible for annual dividends. Yep, this one could accumulate dividend also. All right. That is the basic difference between the two. Now, in general, I do like term, but when does it make sense for you to get whole life? Number one, two things you have to consider, okay? Number one is, do you have the self-discipline to set money aside and not touch it? Number one. Because if you're going to touch it, you might as well go whole life, because that is like a forced investment on your part. Just like contributing money to IRA or KEO plan, that is forced investment, because if you withdraw the money before your retirement age of 59 and a half, you get penalized. So there is something there to make you think twice. Number two, you should know a little bit about investments. If you don't know how to invest your money, you might as well give it to somebody who knows what they're doing, although they will pay you less because they will keep the difference. That's their profit. They don't do this for free, okay? So those are the two fundamental things. If you think you have the stamina to tolerate the ups and downs in the investment, you know, and you have a basic idea of where to invest your money, it's better for you to do it on your own. If you do not, get whole life. All right? So that is the basic difference. And what I did is, because I'm now retiring, and I do this every 5 years, I looked at what I did before and I said, gee, did I make a decision correctly? And I do this about once every 3 to 5 years, because situation may change, new plans may be coming up, and that's another thing. With the term, if I decide I don't want it anymore or I want to change to another plan, I can do it. I lose nothing, okay? But on the whole life, you already have so much money invested, you will lose something, but you could still do it if you want, okay? So hopefully this will guide you through your planning process on what kind of life insurance you should buy. And please do share this video with other people who might be interested in this topic. And for the younger generation, good luck to you, because 30 years from now or so, you'll be looking at it and say, gee, did I make the right decision? And I'll tell you something, I made the right decision. All right? Thank you very much for watching, and make it a great day. Please do subscribe unless you have already done so. Thank you.